There is a number in the silver market that most investors are watching, but the bigger story may not be the price itself. It is the changing way governments are beginning to think about silver. For decades, silver was treated mainly as an industrial metal, a precious metal, or an investment commodity. But according to the source material we are examining today, that perception is changing. The United States has added silver and copper to its official list of critical minerals, putting silver into a category connected directly with economic and national security. Welcome to Macro Bullion. I'm Alex James, an independent economic analyst, and today we're going to look beyond the dramatic silver price targets and examine the structural forces behind this market. Because the important question is not simply whether silver can reach some extraordinary number. The important question is why governments, industries, and investors are suddenly paying much more attention to the physical metal itself. The source material says silver has been trading around the mid-$60 range this month after previously moving above $90 and briefly above $100 before pulling back as Federal Reserve expectations changed and some geopolitical tensions cooled. That volatility is important because it shows just how quickly sentiment can change in a market where monetary expectations, geopolitical risk, and physical supply are all interacting. But the potentially bigger development happened away from the price chart. The current U.S. administration formally placed silver on the critical minerals list alongside copper. According to the source, that classification could open the door to measures such as stockpiling, domestic production incentives, and trade restrictions, while also creating discussion around the possibility of rebuilding a strategic silver reserve. And this is where history becomes relevant. The source points out that the United States once held a massive strategic stockpile of physical silver. At its peak in 1942, that reserve reportedly exceeded 3 billion ounces, compared with roughly 800 million ounces of annual global mine production today. The historical comparison is striking because it shows that government ownership of enormous quantities of silver is not some completely new concept. The bigger issue today is supply. The source says the United States imports more than 60% of the silver it consumes by some estimates, while demand from solar manufacturing, electric vehicles, and data center infrastructure is increasing. At the same time, global mine production is only around 800 million ounces annually, leaving policymakers potentially trying to secure additional physical metal in an already tight market. That creates a very different silver story. This is no longer only about investors buying coins or traders betting on the next move in futures. It is about governments thinking about resource security, manufacturers competing for essential inputs, and a global economy increasingly dependent on technologies that require silver. And that brings us to the real question for this video. If silver is becoming strategically important at exactly the moment when industrial demand is expanding and physical supply remains difficult to increase quickly, what happens if governments themselves become another major buyer? That is where the silver story gets much more interesting. Now, the supply side becomes critical because silver has a structural problem that is very different from gold. Global silver mine production has remained around the 800 million ounce range, with limited flexibility to increase output quickly. One reason is that much of the world's silver is produced as a byproduct of mining for other metals such as copper, lead, and zinc. That means a higher silver price does not automatically create an immediate surge in silver production. At the same time, industrial demand continues to expand. Solar photovoltaic manufacturing requires silver as a conductive material. Electric vehicles use more silver than traditional internal combustion vehicles, while data centers and electronics are adding another source of demand as the global technology and artificial intelligence build-out accelerates. The source describes this combination as a structural supply and demand problem, with several consecutive years of market deficits in which consumption has exceeded newly mined and recycled supply. And this is where the physical market becomes more important. If inventories held in major exchange and financial centers become thinner, while industrial users continue requiring physical metal, the market can become increasingly sensitive to disruptions. The source also points to elevated lease rates at certain periods as a signal that readily available physical silver can become scarce. Now add geopolitics. According to the source, China introduced silver export controls earlier this year, restricting the outward flow of a metal that it produces and refines at significant scale. Whether those restrictions remain tight or change over time, the broader implication is important. Silver is becoming part of the competition over strategically important resources, and the United States is moving in the same general direction from the other side. The addition of silver to the U.S. critical minerals list reflects a broader shift toward resource security. The source connects this development with the United States and Australia pursuing cooperation on critical minerals, including discussion of joint reserves and price support mechanisms. The underlying idea is that governments increasingly want greater control over materials that are essential to their industrial and strategic capabilities. But there is an important warning here. None of this guarantees that silver prices will move higher in a straight line. Policy can change, tariffs can be delayed, negotiations can replace restrictions, and markets can react violently when investors realize that an expected policy action is not going to happen. The source itself points to an example where silver fell sharply after the administration delayed new tariffs on critical mineral imports in favor of negotiations. So we need to separate the structural trend from the short-term price reaction. The structural trend is toward governments paying more attention to physical resource security. The short-term market can still move in the opposite direction. And there is another historical lesson worth understanding. The source takes us back to August 1971, when President Nixon ended the dollar's final formal link to gold. What followed was the stagflationary period of the 1970s, when high inflation and weak economic growth existed simultaneously. Gold subsequently moved dramatically higher during that decade. Silver also experienced an extraordinary move, although its history during that period contains an important warning. The Hunt brothers attempted to corner the silver market, creating enormous speculative excess before regulators changed trading rules, and the market collapsed sharply. That episode gives us a lesson that remains relevant today. A strong long-term fundamental story does not eliminate volatility. In fact, when physical scarcity, monetary uncertainty, and speculative enthusiasm collide, price movements can become extreme in both directions. And that is why the next part of this silver story is not really about a price target. It is about the institutions buying gold, the strategic importance of physical silver, and the psychological forces that can cause investors to chase a market precisely when the risk is becoming greatest. But there is another piece of this story that is easy to miss, and that is the behavior of central banks. Because while retail investors debate whether silver can reach another major price level, some of the world's largest institutions are making a much longer-term decision about gold. The source says central banks purchased roughly 240 tons of gold during the first quarter of this year, describing it as one of the fastest quarterly buying rates in more than a year, even while gold was trading above $5,000 an ounce. That behavior matters. Central banks normally have a very different investment horizon from individual traders. They are not trying to capture the next $5 move in a metal. Their decisions are connected to reserves, currency diversification, and long-term financial security. The source specifically points to countries including China and Turkey increasing gold holdings while reducing some reliance on U.S. Treasury assets. It describes this broader process as de-dollarization, while also making an important distinction. Diversification away from the dollar does not mean the dollar is about to collapse. That distinction is important because the extreme version of this story can become misleading. The dollar remains deeply embedded in the global financial system. But if major institutions gradually diversify their reserves, the effect can accumulate over years rather than days. And that brings us back to silver. Silver does not have the same central bank reserve role as gold. Its investment case is different because it combines monetary characteristics with industrial demand. But if governments increasingly view physical commodities as strategically important, silver could become part of a much broader resource security conversation. The source describes this as a geopolitical realignment. The competition between the United States and China is no longer limited to traditional trade. It increasingly involves access to rare earths, lithium, cobalt, critical minerals, and the processing capacity required to turn raw materials into industrial inputs. Silver's inclusion in the critical minerals framework therefore matters because it recognizes the strategic value of physical supply. But there is a psychological side to this market as well. When silver starts moving rapidly, investors can become focused on the price rather than the underlying mechanism. A rally creates excitement, a sharp correction creates fear, and both reactions can push investors toward decisions based on emotion instead of analysis. The source explains this through the way our brains respond to financial uncertainty. Sudden market moves can trigger a rapid emotional response before deliberate reasoning catches up, while rapidly rising prices can create a powerful fear of missing out. This is especially important in silver because the market can be extremely volatile. The source gives three composite examples. One investor maintains a modest allocation and does not react to every price movement. Another buys heavily after seeing an explosive rally and then panics during a correction. A third uses leverage and discovers that even being broadly correct about the long-term story does not protect against being forced out of a position during a short-term decline. The lesson is straightforward. A strong fundamental thesis does not make an asset immune to volatility, and leverage can turn ordinary volatility into a much bigger problem. This is also why I would be careful with the headline numbers surrounding silver. Claims of silver reaching extremely high prices can attract attention, but a price target is not evidence by itself. The source makes that point very clearly. Anyone presenting a precise future silver price with certainty is giving you a guess rather than a guaranteed forecast. The evidence is stronger when we talk about structural forces: debt, currency diversification, physical supply constraints, industrial demand, and geopolitical fragmentation. So the real silver story is not simply silver is going to explode. It is that multiple structural forces are converging around a metal whose supply cannot necessarily respond quickly to every new source of demand. And that is what we need to bring together in the final part: the strategic shift, the supply picture, monetary policy, and the difference between a legitimate long-term thesis and an exaggerated price prediction. As we bring this discussion to a close, it becomes clear that the real silver story is not about one prediction, one politician, or one dramatic headline. It is about a convergence of forces that have been building for years and are now beginning to intersect at the same time. On one side, governments are becoming increasingly focused on resource security. The addition of silver to the U.S. critical minerals list reflects a growing recognition that certain materials are strategically important to economic and national security. According to the source, that classification could support domestic production incentives, stockpiling efforts, and even discussions about rebuilding a strategic silver reserve. On another side, the physical market remains under pressure. Global silver production has struggled to grow rapidly, while demand from solar energy, electric vehicles, electronics, and data center infrastructure continues expanding. The source argues that multiple years of market deficits have already drawn down inventories, creating a situation where physical supply is becoming increasingly valuable. Then we have the monetary side of the equation. Government debt continues to grow, interest rate decisions remain politically and economically sensitive, and central banks are responding by accumulating gold reserves at a significant pace. Whether one agrees with every interpretation of these trends or not, the broader message is difficult to ignore. Major institutions are actively thinking about long-term financial resilience. But this is where many investors make a mistake. They see these structural trends and immediately jump to a specific price target. The source explicitly warns against that thinking. It states that anyone claiming certainty about a future silver price is ultimately offering a forecast rather than a guarantee. The evidence supports the existence of powerful long-term forces, but it does not support certainty about exactly where silver will trade next year, 5 years from now, or 10 years from now. And that distinction matters, because successful investing is rarely about predicting an exact number. It is about understanding probabilities. The probability that governments continue prioritizing critical resources, the probability that industrial demand remains strong, the probability that central banks continue diversifying reserves, the probability that debt and monetary pressures remain part of the global macroeconomic landscape. Those are the forces worth watching, not the daily noise, not the sensational headlines, not the emotional reactions that appear every time silver rallies or corrects. The source spends considerable time discussing investor psychology, and for good reason. Fear and greed have destroyed more portfolios than any commodity ever has. Investors who become obsessed with short-term moves often end up buying at emotional highs and selling during emotional lows. Meanwhile, disciplined investors focus on the bigger picture and maintain a process that can survive volatility. My takeaway from this analysis is simple. Silver's long-term story is becoming increasingly connected to three major themes: resource security, industrial demand, and monetary uncertainty. Any one of those themes alone would be significant. Together, they create a market that deserves serious attention. That does not mean silver can only go higher. It does not mean corrections cannot happen. And it certainly does not mean every extreme price prediction will come true. What it means is that the structural case for paying attention to silver is stronger than it has been in many years. This is Alex James for Macroeconomic. I'm an independent economic analyst, and as always, this content is for educational and informational purposes only. It is not financial advice. Do your own research, verify the data, understand your own risk tolerance, and never make investment decisions based solely on one analyst, one video, or one headline. Because in the end, the investors who succeed are usually not the ones chasing the boldest prediction. They are the ones who understand the forces driving the market before everyone else does.